Hey, what's up traders? This is Jay from swimtrading.com giving you my analysis here live from Singapore. So yesterday we have a 2% down day with Dow, the S&P 500, the Nasdaq, everything tanking, and even oil tanked about 1.7%. So which means now everything that I'm tracking is heading downwards. So where are the money flowing to? Well, best guess, look at bonds, all right? So without going there, today I'm going to talk about something else different. How much further is this market going to go? Well, I believe that's the $1 million question right now. So on the S&P 500, you can see that it broke down a key level, which was the 2,600 zone. And therefore, you can see after that, all the news are just pessimistic. Well, the first one over here, we have these are the biggest stocks that are in a bear market. Dow is on the verge of a death cross, and then you have more than S&P 500 stocks are in a bear market. The S&P 500 lower low warns that the worst is yet to come, and stocks still not showing the panic selling that's associated with market bottom. Well, that's a bullish one. So apart from that, everything else is just bear, 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 and bear. So in my years of trading the market, when it comes to news, I'm quite skeptical right now to read or just rely on the sentiment based on the news, because most of the time where it seems like doom and gloom everywhere else and all the news are just down, bear, pessimistic, guess what? The market will consolidate and find another leg up. So this has happened over and over and over again in the last 8 years I was trading. Alright, so this is the first thing on the news. Let me bring up the charts. So the charts are over here. So that's, let me pull up the S&P 500 first, so this is the S&P 500. As you can see, my drawings are over there. And zooming out first, we can see that it is on a clear upside, definitely. The uptrend is still intact. However, it does seem that the whole 2018 was a type 4 consolidation market, just sideways. And right now, we are on course to close the year in the bearish territory. All right, so zooming into 2018 only, we can see that, of course, there was a triple top 1, 2, 3 around the 2,800 zone, and guess what? Thereafter, the market just came down, does a pullback, and then just came down in the last two sessions pretty fiercely because of a gap here and also of a gap there. And here it is at the S2 support. So apart from support, resistance, and trend line, this is one other thing that I refer to, which is the pivot levels, the monthly pivot levels. All right. So on the S&P 500, we can see that it's at the S2 level, and I'm expecting it, if there is any downside to go, if there is going to come to 2,500 point, right, it should do a retest, given that the recent drop was quite drastic. So it should do a consolidation over here, does a retest of this key region before it hits downwards to 2,500. So that's on the S&P 500. Now let's look at the S&P 500 futures. So with the ticker symbol /ES, and this is what I have on. Again, it's on the upside. Oops, I'm sorry. So again, it's on the upside, and you can see that clearly, it paints a slightly different picture from the S&P 500. Why? Because on the S&P 500, it has broke below a key level, which was the 2,600 zone. Now, on the S&P 500 futures, you can see that this was the low created in February. This was the low created in April. And currently, the market is still in this demand zone, denoted by the green now, of course, denoted by the green. And it also, similarly to S&P 500, is also at the S2 monthly pivot. So I'm expecting the selling to abate at least for the next few sessions. And all of this hinges on whether on Wednesday the trajectory of the interest rate increase. Are the Feds going to increase it much higher? How many times are they going to increase? And if the FOMC decided to be generous, to be playing charity, then what? Guess what? They may stop the rates increase the third time for this year. So because this year is slated to raise by another 0.25%, and if they don't, you can be sure to expect that the market is going to rally upwards and is going to test the previous support, going to turn into resistance level, and that's what I'm expecting if they do not raise the interest rate. But unlikely, because they have to, how do I put it, save some face, in the sense they need to appear to be independent of the government, even though Trump have been putting pressure on them. All right, so this is on the S&P 500 futures, and today I want to share with you a technique that is widely available but not really known, which is to read the market breadth ratio in order not to panic when such things happen while you are trading. All right, so let me bring it back. I'm going to go over to stockcharts.com. They have many brilliant tools over here that allows us to track the market, and best of all, they are all free, so go check it out. All right, so on the S&P 500, right now I'm pulling up this thing called the NYA50R. So the NYA50R is more for the short term. All right, it's more for the short term. So what do I mean by short term? Meaning a few weeks, 2 weeks to 3 weeks, that kind of time frame. And we can see that on the NYA50R, we have a top over there is around 80. We have a bottom over here which is around 12. And of course, we have the neutral line around 50. So what I want you to imagine from here is as such. Imagine the 50 line being a pole. And okay, let's say you are anchored here and you are tied to a rubber band from this pole. So there will be a limit of how high you can run to, and there will be a limit to how high or how low you can run to, away from this mean, away from the mean. Okay, so what it does is every time it reaches an extreme, which is in the case of October 2018, just recently, you can see the market does a rebound up again to the mean level, which brings the market up to 2,800 on the S&P 500. And thereafter, the recent retreat denoted by the O column seems to bring it down to 16.88. So you can see that with the bottom being somewhere between 10 to 12, okay, pardon the ugly handwriting, is awful to write with mouse. So with the bottom being 10 to 12, and right now we are at 16.88, so we are somewhere near the bottom. All right, we are somewhere near the bottom. So when we are near the bottom, this means that the stocks are ripe for a bounce. So whether we continue downwards again, well, that's anybody's guess. But at least one thing I'm sure is, because majority of the stocks are already reaching the extreme, leaving a minority of them still yet to reach this. So what are the chances of it heading down in one direction without doing a reversal first? Okay, so that's the whole idea of reversal to mean. All right, so this is on the NYA50R. Let's look at the same thing on the S&P 500. Similarly, we are able to see that there is a top here around 70 to 80, and then there is a bottom here around 12. The same thing. And look at this level, 16. Oops, totally missed the 16 over there. Horrible. So look at the 16 level over here. Again, we are very near the bottom of 12. We are very near the bottom. So the short-term bottom is pretty near, and although there still may be further downside to go, but I believe that there should be some consolidation sideways before the market makes another leg down, if they are going to go down. All right, so this is the short term. These two are the two short-term ones, and usually they would agree with each other on the New York Stock Exchange as well as the S&P 500. So now let's look at the medium-term ones. So what are the medium-term ones? The medium-term indicator that I'm going to use is this thing called the Bullish Percent. If you have no idea what it means, go and Google it out and check it out. Check out the definitions on stockcharts.com. All right, how to read this? Check out the definition. On here, we can see that there is a ceiling over there around 80%, and we also have a extreme bottom around 4% and an intermediate bottom which is around 20%. So right here, where is the market? Right now the market is at 29, which means that there is about 70% of the stocks that are not bullish and only about 30% of the stocks that are still bearish. They are still bullish. Sorry. So are there any more downside in the medium term? Well, I would think so. If I would want to see it coming down to around this area, which is around 20 to 22% area, before a consolidation and a bounce on the technical charts. All right, that's what I want to see in the medium term. And let's see if the S&P 500 will agree with the same, paints the same picture. So here, clearly, we can see that S&P 500, the ceiling is slightly higher, it's about 88. The floor is, intermediate floor is somewhere around here, the 20% region as well. So this 20% region, where are we? We are at 27.8, which means that about 72% of the stocks are already bearish on the S&P 500. That leaves a little more room for them to go down slightly further. All right, and it should abate. The tank should stop somewhere around 20% zone before a mean revision happens, of course. So where is the mean in this case? Well, the mean is, of course, at the 50% zone. And every time it reaches an extreme, it should snap back. I'll not say snap back, but it should at least creep back to the mean. All right. So there you have it. These are what I have to share with you using free tools on stockcharts.com to tell us the market extreme. And this is how I use these tools to read the market, to spot market extremes, to know whether the market is at a bullish extension point or is it at a bearish extension point. Okay, so the last thing before I call it a day, I would want to share with you a stock over here that has caught my interest, which is over here. So I wanted to show you Goldman Sachs. So this stock has been spectacular in the sense when in the February of 2018, when the whole market tanked, well, this tank here is really subdued. It didn't tank much. And guess what? When the whole market was rallying in this area over here in May, June, July, August, Goldman Sachs went down. Then it does a pullback, and then it continued down, a pullback again, and then finally it came down in the last leg. And the last leg was particularly fierce. So let me zoom into the most recent action. Right over here, we can see that this is around 230, and from 230 all the way down to 168, it took barely just about 4 to 5 weeks, and this was crazy, man. This was really crazy. And will it stop falling for a while? I think so, and let me share with you why. Over here, for this reason, well, first thing, volume is pretty high over here, and then we have a gap down over here. So I would like to think of this as an exhaustion gap, because especially with the volume spiking up to a much higher level than the previous cluster. Okay, so volume spike up, and then we have a gap down, and then we have a small candle without any conviction. That's a sign of that's a sign of an exhaustion. And whether does it exhaust or not, well, I can't be sure, but at least the signs are there. So what I'm watching out here is this is the S1 pivot support on the Goldman Sachs, and I am expecting it to come back and retest this level if any further downside were to be made. All right, so I would want to see it bouncing off the 175 level first and seeing how does it react there, because it does seems to me that the short-term extreme has been reached just by reading the volume as well as the price action. All right, so if I were to zoom down, where is the next S2? The S2 is at 158 thereabouts. But then again, that's why I mentioned I would like to see it consolidate and resisted off here before it makes a leg down to the 160 region. So this is a stock with a lot of bearish potential, and especially if the whole market is not doing well, this is very weak right now. Goldman Sachs is very weak. All right, so be sure to check them out and do your own diligence. So that's all I have to share with you. Market breadth and Goldman Sachs, as well as my technical analysis on S&P 500 and the futures itself. I hope that this year has been great for you, and this is me signing off. Hope to catch you soon. Trade safe. Goodbye.